Chris, let me start with you. Given what we're seeing right now, are we looking at a long, cold winter, would you say?
Unfortunately, David, I think we are. I think the Fed, with these employment numbers, the Fed knows that they have to continue this pace of aggressive tightening, and they're going to do so the next meeting and the next meeting after that. And I think, which the street is pricing in, but I think after that, they're going to have to keep it up. And that's going to be into the winter, and it's going to be a tough time.
So what do you say, Erin? Is it going to be a rough winter?
I think it is going to be a rough winter. I think that the bands of uncertainty are quite wide for next year. The Fed is tightening into an economic slowdown, and we haven't even seen the real impact of that slowdown yet. We're just starting to see signs of a gradual slowing, but likely we'll continue to see that into next year. And we think that we're heading into a recession into early 2023. And at that same point, just given the level of inflation, the Federal Reserve is now really challenged to be able to arrest that inflation, get it under control, despite what happens to the economy. So I think that really poses a challenge for the Fed, and we'll likely see something that's fairly unprecedented, which is continued financial conditions tightening and Fed tightening into an economic slowdown, even if it really leads to a harder landing than what the Fed's anticipating.
And Erin, I'd push back a little bit. I actually think we're in a recession right now. It's not a very strong one, and it doesn't hurt a lot, obviously, with employment growing. But we did have a negative GDP in the second quarter. Third quarter is mild. To me, anything below 1% in the USA feels like a recession. But so what you're saying is you think it's going to be we'll actually have a good traditional hard negative recession with rising unemployment, which is exactly what Powell has said. I mean, that's his forecast.
Yeah, I think that's right. I mean, our view at PIMCO is that we'll likely see unemployment rise to about 5% by the end of 2023. And so right now we're sort of seeing some of those early signs, but we really haven't seen the full brunt of financial condition tightening yet. That's more to come. So we are going to continue to see a slowdown. And I think that's really going to hit in the first quarter of next year and into the second quarter of 2023.
Chris, given where we are with inflation right now, all the concerns about inflation, if we are heading into a recession or even are already in one, no matter how long it is or how short it is, what are the tools the Fed has to use? Because typically you turn to the Fed and say, okay, start cutting interest rates. Doesn't look like they're going to do that in all likelihood.
No, they're going to raise interest rates. They only have one tool. They have their mouth that can jawbone the market, which is what they're doing. They have the dot plot, which is going to indicate or direct the market. But the only tool they have is short-term interest rates and the Fed funds rate. And that's what they're using aggressively. I mean, good grief, 75 basis points. Those are big bounces. Through history, you've got to go way back before you have that aggressive tightening of monetary policy. And they have to shrink the balance sheet. So as they move through that, he's already said he's going to hurt employment. Yet we have stronger numbers. I think the numbers, there's something strange in the numbers this week, just like last month, but we'll see how that balances out. We're going to have a tougher time. And, I think the question is going to be about corporate earnings. You got CPI next week, and then you got the banks starting to roll out with their earnings.
Erin, has the market priced in the diminishment of earnings at this point, corporate earnings?
No, I don't think that they have. What you've seen since the beginning of the year is equities have derated, largely driven by the market multiple. So you've seen the market multiple for the S&P 500 derate from about 21.5 times to about 16 times today. Keep in mind that traditionally in recessions, the market multiple is somewhere between 14 and 16 times. So we're just at the upper end of where we typically are in recessions. And we think that you could see a little bit more derating from there. That's not really the challenge for the market. The challenge for the market is that when you look at corporate earnings for next year, the market's pricing them to be up 7.5% for consensus. Our forward-looking models are expecting them to be down about 9%. So that's north of a 15% differential versus what the market's pricing for next year and what we think it's likely to be. Also, historically, during recessions, earnings fall about 27% on average. So there's real downside risk to our forecast and certainly to the market's forecast. And I think that's where you're going to see the real pressure point for the market in early next year. What's driving that is margins. We're at record high margins right now. The street is expecting that margins are going to expand further from here, so even higher than, and hit new record highs. We've never seen that in a recession before. So I think the market's really mispriced, and that's where the pain's going to come from.
Erin, I've got to ask you if you know, we're already down 23% so far this year. How much lower do you think we can go? Do you see a support level in the S&P?
I think that in a modest or moderate recession, the market probably bottoms out about 3250. There is downside risk if we see further, you know, sort of a more severe or harder landing from there. But, you know, 3250 is still down about 15%. So I do think that there's still room for the market to fall further. Where are you looking, Chris, in terms of your estimates?
Yeah, no, I agree 3250, but I mean, that's a negative 36 on the year, which is, you're like me, we have asset allocation portfolios. Where do you hide in that kind of a negative market? You've got bonds with the rates rising, so you're going to have continued negative returns out of bonds, and then you know, a negative 30 out of stocks. That's a rough calendar year. Where do you hide?
Well, I think there have been actually market opportunities that have arisen since the start of this year. Cash rate right now at 2-year bonds are yielding north of 4%. Now that's not a sexy return by any, you know, sort of stretch of the imagination, but if you can lock in 4%, you know, add a little bit of spread on top of that, you know, in IG corporates that give you an additional, you know, 2% or so. That's about a 6% return over the next couple of years. That's high quality paper that you can invest in. So I wouldn't, you know, sort of rule cash out as an option. I think that that's somewhere where you can hide and really not expect that much volatility and really consistent returns, and sort of hide out there until we see the market's bottom and you can start incrementally moving back into risk. But we can't, I think you need to keep in mind as an investor that if the core of your allocation of your portfolio, which is sort of cash and core fixed income, isn't stable, then you really can invest in the outer ring assets. So you know, we really have to stabilize rates in order to move out the risk curve into other asset classes. Right now, cash is a pretty good option.